The bank just approved you for $350,000. Your real estate agent says, "Congratulations, let's go shopping." And for a second, you feel like you made it, like the system is finally working in your favor. But nobody in that room is looking out for your budget. Nobody ran the numbers on what your life looks like after you sign. That approval letter isn't a recommendation, it's a ceiling. And if you buy anywhere near that ceiling, you're going to feel it every single month for the next 30 years. Here's what the bank actually does when it approves you. It looks at your gross income, not your take home, your gross, the number before taxes, before health insurance, before your 401k contribution. If you earn $70,000 a year, your gross monthly income is about $5,833. The bank applies something called the 2836 rule. It says you can spend up to 28% of your gross income on housing. That's $1,633 a month. Sounds reasonable until you remember. Your actual paycheck after deductions is closer to $4,400 a month. That $1,633 housing payment is now eating 37% of the money you actually see. And the bank doesn't factor in your car payment, your student loans, your groceries, your kids' daycare, your gas. The bank calculates what you can technically pay back, not what you can comfortably live with. Those are two completely different numbers. Most people think their housing cost is just a mortgage payment. It's not even close. Your real monthly housing cost includes at least 5 things. First, the mortgage itself. On a $350,000 loan at 7% interest over 30 years, that's about $2,329 a month in principal and interest. Second, property taxes. The national average is roughly 1.1% of your home's value per year. On a $350,000 home, that's $3,850 a year, or about $321 a month. Third, homeowners insurance. Average cost runs about $150 to $200 a month, depending on your state and coverage. Fourth, private mortgage insurance, what most people call PMI. If you put less than 20% down, you're paying this. It's typically 0.5% to 1% of the loan amount per year. On a $350,000 loan, that adds $146 to $292 a month. Fifth, maintenance and repairs. The general rule is budget 1% of your home's value per year. That's $3,500 a year, or $292 a month. And this isn't optional. Roofs leak, water heaters die, appliances break. When you rent, that's the landlord's problem. When you own, every broken thing is your broken thing. So let's add it up. You thought you were paying $2,329 for your mortgage, but your actual monthly cost is somewhere between $3,238 and $3,434. That's a difference of $900 to $1,100 per month that nobody talked about at the closing table. Now let's zoom out, because the monthly number is scary, but the lifetime number is where this gets real. You borrowed $350,000 at 7% interest. Your monthly principal and interest payment is $2,329. Over 30 years, that's 360 payments. $2,329 times 360 equals $838,440. You borrowed $350,000. You paid back $838,440. The difference, $488,440, is pure interest. That's money that goes straight to the bank. You didn't get a bigger house for it. You didn't get a better neighborhood. You just paid the cost of borrowing. And that's only the mortgage. Add in property taxes over 30 years at $321 a month. That's $115,560. Add insurance at $175 a month for 30 years. That's $63,000. Add maintenance at $292 a month. That's $105,120. Add PMI for the first 7 to 10 years at $146 a month. That's another $12,264 to $17,520. Now add it all up. The total cost of that $350,000 home over 30 years is approximately $134,384 to $1,139,640. Let that sit for a moment. A $350,000 house costs you over $1. $1 million by the time you're done paying for it. According to the Consumer Financial Protection Bureau, nearly half of mortgage borrowers say they didn't fully understand the terms of their loan at closing. That's not stupidity. That's a system designed to move fast so you don't do this math. The bank benefits when you borrow more. The real estate agent earns a bigger commission when you buy more. Nobody in that transaction makes more money by telling you to buy less. The housing industry is not built to help you buy smart. It's built to help you buy fast. Think about how the process works. You get pre-approved. An agent shows you homes at the top of your budget, not the bottom. You fall in love with granite countertops in a big backyard. Then the lender locks you into a rate, and everyone rushes to close within 30 days. According to the National Association of Realtors, the median time between first seeing a home and closing on it is about 10 weeks. You spend more time deciding on a car than you do on the biggest purchase of your life. And the incentive structure is broken. Your real estate agent makes a percentage of the sale price. A higher price means a bigger check. Your lender makes money on the interest rate. A bigger loan means more interest collected. The title company, the appraiser, the home inspector, they all get paid only if the deal closes. Nobody in the room profits by telling you to wait. Nobody benefits when you say, maybe I should buy something cheaper. The system moves fast by design. Urgency is the product. According to Zillow, 75% of recent buyers reported feeling rushed during the process. That's not a side effect. That's the business model. Your confusion is profitable. Now, you might be thinking, so should I just never buy a house? No. Home ownership can absolutely build wealth, but only if you buy within your actual means, not the bank's number, yours. The biggest objection people have is, renting is throwing money away. And that sounds right until you do the math. If buying a home puts you at 40% of your take-home pay on housing, and you can't save, can't invest, can't handle emergencies, you're not building wealth, you're building stress. So here's the smarter approach. Step 1. Use the 25% take-home rule, not 28% of gross, 25% of your actual take-home pay. If you bring home $4,400 a month, your total housing costs, mortgage, taxes, insurance, everything, should stay at or below $1,100. Step 2. Save a real down payment. The bigger your down payment, the smaller your loan. Put down 20% and you eliminate PMI entirely. That saves you $146 to $292 per month. On a $280,000 home, 20% is $56,000. That takes time, and that's okay. Step 3. Buy below your approval. If the bank says $350,000, look at homes around $220,000 to $260,000. That gap between what you're approved for and what you actually spend, that's where your financial freedom lives. According to Harvard's Joint Center for Housing Studies, cost-burdened households, those spending more than 30% of income on housing, are 3 times more likely to skip meals or medical care. Buying less house literally protects your health. 2 people, both earning $70,000 a year, both taking home $4,400 a month, same city, same goals, same starting point. Person A gets approved for $350,000 and buys a house at that price. Their total monthly housing cost hits $3,400. That's 77% of their take-home pay. They have $1,000 left each month for everything else: groceries, gas, car payment, phone, and emergencies. There's nothing left to save, nothing left to invest. Every unexpected expense goes on a credit card. After 10 years, person A has about $45,000 in home equity, but $22,000 in credit card debt and 0 savings. Person B does it differently. They get the same $350,000 approval, but they buy a home for $230,000. Their total monthly housing cost is about $2,050. That's 47% of take home. Still higher than the 25% rule, but manageable. They have $2,350 left every month. They put $500 into a savings account. They invest $400 a month into an index fund, averaging 8% annually. After 10 years, person B has about $55,000 in home equity, plus $60,000 in savings, plus roughly $73,000 in invested assets. That's $188,000 in total net worth. Same paycheck, same city. The only difference, person B knew the real number, not the bank's number, their number. This is not your fault. The system wasn't designed to protect you. It was designed to close deals. But now, you've seen the math. You know what the bank doesn't tell you. You know what the agent won't tell you. You're not someone who just accepts the first number anymore. You're someone who runs their own numbers, and that changes everything. Subscribe and turn on notifications. Next week, we're breaking down the hidden costs that hit you after you buy the house.